It was April 2020. The market had just suffered one of the fastest drops in history, and then, almost as if mocking every fear in the headlines, stocks roared back. I remember one trader in particular. Let's call him Chris. Chris had been riding high in late 2019, convinced his instincts could read the market better than any algorithm. He saw tech stocks leading the charge and bought more. But when COVID headlines hit and prices fell hard, his confidence collapsed even faster. He sold everything near the bottom. It felt safe. And for a moment, he slept better. But 2 weeks later, prices started climbing, and not just climbing, exploding. Chris couldn't stand watching from the sidelines, so he jumped back in, just as the first rally peak started to fade. He lost again. This time, not from a crash, but from chasing too late. That's when he came to me, frustrated. How do you know when to hold, when to sell, and when to get back in without feeling like you're guessing? That question is why we're here today. Because the truth is, most traders don't lose from picking bad stocks. They lose from picking bad moments. In this episode, I'm going to show you the dual momentum approach, a way to capture the upside when trends are real and step aside when they're not, without letting bias, fear, or ego sabotage you. It's a system that works because it accounts for human psychology, not in spite of it. My name is Ben, and welcome to Zen Stock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. A few years ago, I came across a book that put words and rules to something I'd been doing intuitively for years. It was Dual Momentum Investing, an innovative strategy for higher returns with lower risk by Antonacci. Antonacci's work connected two ideas. Most traders treat separately, picking the strongest performers and knowing when to stand aside. He called them relative momentum and absolute momentum. When you combine them, you get a framework that tells you what to buy, and just as importantly, when not to buy. Back in 2015, I thought I had momentum trading nailed. I was running a small, tech-heavy portfolio, and every chart I looked at was green. It felt like the market was handing out free money. I was holding shares of a fast-growing semiconductor company, the kind where every earnings report brought a new high. But my strategy was just looking for whatever was going up the fastest and piling in. Then, a string of soft economic data hit the headlines. Prices didn't crash overnight, they just started slipping. It didn't look like much at first, a few red days mixed with green ones. I told myself, this is just noise, it'll bounce. But the bounce never came. By the time I finally sold, the stock was down over 30%. And here's the kicker, 2 months later, that same stock started climbing again. This time, I refused to touch it. I still had that loss burned into my brain. A friend of mine who uses absolute momentum rules bought back in when the trend turned positive again. He didn't catch the exact bottom, but he also didn't ride the entire drop. By the end of the year, he was up. I was still digging out of a hole. That was the moment I realized, momentum isn't just about finding winners. It's about knowing when their trend is actually healthy, and having a rule to step aside when it's not. That's exactly what Antonacci's dual momentum framework does. It keeps you in the strongest performers when trends are favorable, and it moves you out before a small dip snowballs into a portfolio drag. I learned the hard way that just holding because something was strong is a dangerous bet. With dual momentum, I could have avoided that trap entirely. Today we're going to break down the psychology and mechanics of dual momentum. A strategy that combines the power of relative momentum, which compares assets against each other, and absolute momentum, which measures an asset against its own past performance. We'll look at how it works, why it works, and most importantly, how it helps you sidestep the mental traps that keep traders stuck in losing positions or chasing trends too late. This is not about predicting the market, it's about reacting with discipline when the evidence changes. And just to be clear, nothing you hear today is financial advice. It's for education and entertainment. You should always do your own research before putting money at risk. For me, Dual momentum is like driving with both a map and a weather radar. The map, relative momentum, shows you the fastest route. The radar, absolute momentum, tells you when a storm is ahead and it's time to pull over. One without the other leaves you exposed. Together, they turn a risky journey into a planned, adaptable trip. Gary Antonacci calls momentum the premier market anomaly, the tendency for strong performers to keep performing and weak ones to keep underperforming. On paper, it sounds too simple to be true, yet the data is stubborn. In study after study, momentum persists across asset classes, decades, and even different countries. So why does it work? There are two main schools of thought. The first is that momentum is just a reward for taking more risk. But the second, and the one I've seen play out in real traders, is that it exists because of our predictable, irrational behavior. One of the biggest culprits is anchoring. Tversky and Kahneman showed in 1974 that people latch onto their first impression in trading that might be an old price level or a past earnings report and underreact when new information contradicts it. I've seen traders hold a stock because it's only down 10%, it'll get back to my buy price, ignoring the reality that the trend has turned against them. Closely linked is confirmation bias. Once we have a belief, this stock is a winner, we selectively search for data that supports it and dismiss anything that doesn't. It's why traders cling to bullish news even as their chart bleeds red. These biases create inertia. They slow down how quickly the market absorbs new information. That lag is the fuel for momentum. It means trends don't reverse immediately when conditions change. Instead, they drift, often for months, in the same direction. I once coached a trader who bought into a renewable energy ETF after a 6-month rally. But when policy news turned negative and prices started edging down, he brushed it off. He said, "This sector's too strong to stay down for long." 3 months later, the ETF was down over 25%. The chart had been screaming trend reversal the whole time, but his brain was whispering, "Hold on, it'll bounce." Momentum strategists sidestep this trap by replacing beliefs with rules. Instead of asking, "Do I think this will go up?" the rule asks, "Is this going up compared to my benchmark, and is it trending up compared to its own past?" If the answer is no, you don't argue, you act. That's why I say momentum works not despite human psychology, but because of it. The market's inefficiencies aren't random, they're patterned around our shared biases. And if you can train yourself to see the pattern, you can step ahead of it. Relative momentum is the part of the system that answers one question. Among all the possible investments I could hold right now, which ones are winning the race? Antonacci defines it simply: compare each asset's performance to its peers over a set period, often 6 to 12 months, and pick the leaders. In academic terms, this is cross-sectional momentum. In trader terms, it's a leaderboard. I see a lot of retail traders misunderstand this. They think it's about chasing hype. But relative momentum isn't about grabbing the stock everyone's tweeting about this week. It's about looking at a consistent, measurable track record over time. No headlines, no opinions, just numbers. Years ago, I worked with a trader named Alina. She'd had a great run in 2017 buying tech stocks. By 2018, she was convinced that tech was her golden goose. Even when financials and healthcare started outperforming, she stuck with her tech-heavy portfolio. But the relative strength tables told a different story. Tech had slipped to the middle of the pack. When the market corrected, her portfolio fell twice as hard as the broader index. Relative momentum would have shifted her out of lagging sectors and into stronger ones. That doesn't mean abandoning your favorite theme forever. It means temporarily allocating where the strength actually is. The key is that relative momentum is agnostic. It doesn't care if the leader is a high-growth stock, a defensive utility, or an emerging market ETF. If it's outperforming, it gets a seat in the portfolio. One of my favorite studies on this came from Moskowitz and Grimblatt in 1999. They found that industry-level momentum strategies, rotating between the strongest sectors, produced similar returns to individual stock momentum, but with far less complexity and cost. It's why I like applying relative momentum to sectors or asset classes rather than chasing individual tickers. Here's where psychology tries to mess with you. Switching from a laggard to a leader often means selling something you've been emotionally attached to. That attachment can feel like loyalty, but it's really an endowment effect, valuing what you own more than what you don't. Relative momentum forces you to break that attachment. It says, we're running a race here. If you're not keeping pace, you're off the team. The most powerful thing about relative momentum is that it doesn't ask you to predict the future. It just asks, who's winning right now, and acts accordingly. That removes a huge chunk of uncertainty, and uncertainty is where most traders get emotional. But as strong as relative momentum is, it's only half the picture. Because sometimes, the fastest horse in the race is still running in the wrong direction. That's where absolute momentum comes in. If relative momentum is the map, absolute momentum is the weather radar. It doesn't care how fast an asset is running compared to others, it asks, is the wind at your back or in your face? Antonacci defines it simply, take the asset's return over a set look-back period, subtract the return of a risk-free asset like T-bills. If that excess return is positive, the trend is up. If it's negative, step aside, it sounds mechanical. And that's exactly the point. In 2011, I was holding a basket of international stocks. They were still outperforming US equities, so relative momentum said, stay put. But absolute momentum told a different story. Against their own past performance, these markets were slipping below zero excess return. I ignored it. I told myself, they're still the best in the pack. Within 3 months, they were down 20%, and my portfolio felt the hit. That's the trap. Absolute momentum saves you from owning the best asset in a bad neighborhood. Because even if you're beating the others, a downtrend is still a downtrend. I've seen this mistake play out in sector rotation strategies too. Take energy stocks in early 2015. They were outperforming utilities and consumer staples. But absolute momentum was flashing red. Prices had been sliding for months. Traders who stuck with them watched oil crash and their positions sink. Those who followed absolute momentum rules moved into short-term bonds and waited. This is where psychology kicks in again. Selling when your asset is still winning relative to others feels wrong. It's like benching your star player mid-game. But if the weather's turning, your star can still get soaked. I like to think of absolute momentum as your personal stop loss, but smarter. Instead of waiting for a random percentage drop, it measures the underlying health of the trend. When that health dips below zero, you step back. One study that really stuck with me was by Faber in 2007. He used a 10-month moving average, essentially a trend filter, and found it significantly reduced drawdowns without killing returns. That's absolute momentum in another form. Don't fight the tape when it's against you. And here's the part most traders overlook. Absolute momentum doesn't just protect you in crashes. It also frees up capital and mental energy. While you're sitting in safe assets, you're not burning emotional fuel watching red screens. That makes it easier to re-enter when the storm passes. Because storms do pass, and when they do, you want to be ready to run again, not still patching the holes from your last shipwreck. Dual momentum is what happens when you put the map and the weather radar together. Relative momentum picks the fastest route. Absolute momentum checks if the road ahead is clear. With both, you're not just moving quickly, you're moving wisely. Antonacci's process is straightforward. Step 1. Use relative momentum to find the top performing asset over the past 12 months. Step 2. Check its absolute momentum. Is the excess return positive over the same period? If yes, you invest. If no, you shift to short or intermediate term bonds until the trend flips back up. That's it. 2 steps. Yet those 2 steps filter out a huge amount of noise and emotion. I remember working with a trader in 2018 who loved sector rotation. He'd pick the top 2 Morningstar sectors each month based purely on relative strength. When the S&P was trending up, it was a money machine. But in late 2018, the market started slipping. Relative momentum still pointed him toward tech and consumer discretionary, but absolute momentum was already negative. By ignoring it, he stayed fully invested right into a 20% drawdown. Now, imagine if he had combined the two. Relative momentum would have picked the leaders. Absolute momentum would have said, not so fast, the whole market's sliding. He could have been sitting in bonds during the worst of it, ready to re-enter when the storm cleared in early 2019. That's exactly what Antonacci showed with his dual momentum sector rotation model, the DMSR. It rotates into the strongest equity sectors when the market trend is up. When the market trend is down, it moves everything into the US Aggregate Bond Index. From 1992 onward, that simple shift produced higher returns with significantly lower drawdowns than the S&P 500. And here's the kicker. Absolute momentum doesn't just cut risk. In Antonacci's data, it actually improved returns. Because avoiding big losses means you don't need massive gains just to get back to break-even. Psychologically, that's huge. Nothing tests your discipline like watching your account sink and thinking, I need to make it all back. Dual momentum reduces the number of times you're put in that position. It also rewires how you see market moves. Instead of panicking during a correction, you think, if this goes negative on absolute momentum, I'll shift to safety. You're not reacting to fear, you're following a rule. The market will always have storms. Dual momentum doesn't stop the rain, but it does make sure you're carrying both an umbrella and a plan. Dual momentum works on paper. The charts, the backtests, the historical returns, they're all there. But in real life, the hardest part isn't understanding the rules, it's following them. When markets are calm, rules feel easy. You nod at the logic. You tell yourself you'll stick to the plan. But when the screen turns red or green in big, fast moves, your brain starts whispering, maybe this time is different. That whisper is the first step toward breaking your system. In my experience, 3 psychological traps hit traders hardest here. First is loss aversion. Studies by Kahneman and Tversky found that losses feel about twice as painful as gains feel good. So when absolute momentum tells you to exit, you might hesitate, hoping to avoid locking in a loss. The problem, waiting often turns a small, manageable loss into a large, soul-crushing one. Second is overconfidence. After a streak of wins, you start believing your judgment is sharper than the rules. You see a negative trend and think, I'll just hold, I can ride this out. That's when the market reminds you it doesn't care about your streak. Third is confirmation bias. Once you've decided you like an asset, you'll seek out every article, tweet, and analyst note that says you're right, while ignoring evidence you're wrong. Momentum rules strip that bias away if you let them. I once coached a trader named Sam who had a fantastic run using dual momentum for almost 2 years. Then came a sudden market rally in a sector he wasn't holding because absolute momentum was still negative. But the headlines were screaming about the comeback story of the decade. Sam jumped in early, convinced the rules were too slow. 3 weeks later, the rally fizzled and he was down 15%. Following a system isn't about never feeling fear or greed. It's about having a structure that catches you when those feelings make bad ideas sound good. Here's what's helped my own discipline. I write down every trade I take, along with the exact reason based on my system. No gut feeling allowed. If a trade idea doesn't meet the rules, it doesn't get written down. And if it's not written down, I don't take it. The more you practice this, the more the system becomes your default, not your backup plan. When you stick to dual momentum, you're not just trading a strategy. You're trading a set of decisions designed to protect you from yourself. And that's the real edge. One of the things that convinced me to take dual momentum seriously was how consistently it showed up in both academic research and market history. For example, a 1993 paper by Jagadish and Titman looked at US stock returns from 1965 to 1989. They found that stocks in the top 10% of performance over the past 6 months beat the bottom 10% by more than 12% per year on average. That's pure relative momentum at work. On the absolute momentum side, Meb Faber's 2007 study tested a simple trend filter using the 10-month moving average. He found it significantly reduced drawdowns, often cutting them in half, while keeping returns in line with a buy and hold strategy. In other words, you weren't giving up growth to get protection. Antonacci's own research takes it further by combining the two. His dual momentum sector rotation model, applied to Morningstar's 11 US equity sectors from 1992 onward, showed higher total returns and much lower volatility than the S&P 500. In fact, the system spent about 77% of its time in equities and 23% in bonds, yet still outperformed the market. And you don't have to dig through dusty archives to see this in action. Look at the 2020 COVID crash. Absolute momentum on major equity indices flipped negative in March, signaling a move to bonds. By the time markets bottomed, a rules-based investor was sitting in safer assets and ready to re-enter when the trend turned up in late April. Meanwhile, traders who relied only on relative momentum often stayed invested during the worst part of the drop because they were still comparing sectors to each other, missing the fact that the entire market trend was down. For me, that's the real power of dual momentum. It's not just a backtest curiosity, it's a practical, repeatable way to sidestep the biggest hits and keep your focus on the healthiest opportunities. Even with a clean, rules-based strategy like dual momentum, there are a few mental traps that can wreck your results. I see these over and over, even in traders who know better. 1. Anchoring to past prices. You buy an asset at $50, absolute momentum says to exit at 45. But your mind locks onto that 50 entry as the true value. You wait for it to come back. That's not discipline, that's anchoring. 2. Confirmation bias in strong trends. When relative momentum picks an asset you already like, you feel validated. When it drops off the leaderboard, you start searching for reasons to keep it anyway. This is your bias fighting the system. The rule is the rule, no exceptions. 3. Overconfidence. After wins, a streak of good trades tempts you to tweak the rules. You start skipping filters, thinking you can outsmart the signals. That's when the market hands you a loss big enough to reset your humility. The fix for all three? Write down every trade and the exact rule it passed. If it doesn't pass, it doesn't get taken, no matter how tempting the story is. In dual momentum, your edge is consistency. The moment you start making just this once exceptions, you hand that edge back to the market. If you want to apply dual momentum without letting emotions creep in, here are 2 tools I've seen work. Wonders. 1. The 2-column momentum journal. On one side, track your relative momentum picks, the top performer, ERS, over your chosen look-back period. On the other, track absolute momentum status, positive or negative, versus your benchmark. This keeps you from forgetting that you need both signals before taking action. 2. The automatic exit trigger. Decide your absolute momentum rule in advance. It could be excess return over the last 12 months must be positive, or price above 10-month moving average. Write it down. If the rule is broken, you exit, no debate, no delay. The decision is already made. Bonus tip: review your momentum journal monthly, not daily. Momentum isn't about chasing every wiggle, it's about catching sustained moves and avoiding major downturns. With these tools, you remove the guesswork. And once the guesswork is gone, the psychology becomes a lot easier to manage. Take a second and ask yourself, when was the last time you sold something because your rules told you to, not because you felt like it? Do you even have rules that tell you when to step aside, or are you relying on instinct? If you pulled up your portfolio right now, could you explain, in one sentence, why each position is still there based on measurable strength? Or would you catch yourself saying, I just believe in this one, be honest with yourself? Because the difference between a trader who survives and one who burns out isn't luck or timing. It's the ability to act on evidence when it's time, even if it's uncomfortable. If this breakdown of dual momentum gave you a new way to think about your trades, I want you to do one thing right now. In the comments, write down the single most valuable insight you're taking away from this episode. Be specific, because the act of writing it will lock it into your thinking. Then, share this video with a friend who might be struggling with when to enter or exit trades. The psychology in this strategy isn't just for momentum traders, it's for anyone who wants a clear, repeatable decision-making process. And of course, hit like, share, and subscribe so you don't miss future episodes. Master your mind, master the market, trade with confidence, and live with calm.